Okay, so today we're diving into a really interesting one, Vishay Precision Group, or VPG. This is a stock that basically doubled out of nowhere. It went from this kind of sleepy, boring industrial company to a super hot robotics play. But the real story is how it all happened. It's a fascinating puzzle for any investor, really.
And that's where we get to the core of it all, a genuine stock market puzzle. I mean, think about it. The company puts out an earnings report that, on the surface, looks like a total disaster. But the market absolutely loved it. So what on earth did Wall Street see that a lot of people missed?
Right, and this is the big question, isn't it? How does a stock double, after profits just crash by 65%? It makes no sense, right? It's totally counterintuitive. But the answer, and this is the cool part, is hiding just beneath those big, scary headline numbers.
Okay, so let's break it down. Here's the contradiction right here. On one side, you've got revenue for Q4 2025. It actually beat what everyone was expecting by a little over 3%. That's good. But then you look at the other side. Adjusted earnings per share, that's EPS, the profit number everyone watches, it missed by a whopping 65%. I mean, a huge miss. Normally, a report like this would send a stock straight into the ground.
So, to figure this puzzle out, you have to realize something crucial. VPG isn't really one company. It's more like, well, it's a tale of two totally different businesses that just happen to share the same house. And believe me, they are heading in completely opposite directions.
And this chart really shows you what I'm talking about. See that big piece of the pie? 62% of their money comes from what we'll call the legacy business. But the key to this entire story, the whole shebang, is that tiny little 12% slice. That's the growth business. And that, my friends, is where the market found the hidden treasure.
And the difference between these two is just night and day. The legacy business, yeah, it's stable, it makes money, but let's be real, it's kind of boring. We're talking industrial sensors chugging along at 2 or 3% growth. The growth business, though? Whoa, it's brand new, it's explosive, it's exciting as heck, with the potential to grow over 30, even 40%. And what is it? This is the part of VPG that's making components for, you guessed it, humanoid robots.
And that right there, that brings us to the inflection point, the single piece of data that changed the entire game. Buried deep inside that messy, confusing earnings report was this little nugget of gold, a signal that this whole pivot to robotics thing, it wasn't just talk anymore, it was actually happening.
Here it is. This is the number that lit a fire under the market, $37.8 million. This one number, this is the key that unlocks the whole VPG puzzle.
So what is it? What does it mean? Well, it's the total value of new orders for what VPG calls its strategic growth initiatives. Now that's just a fancy corporate way of saying their humanoid robotics and advanced sensor business. And get this, their target for the year was $30 million. They didn't just meet it, they absolutely crushed it by more than 26%. This was the proof, this was the signal everyone was waiting for.
And it's not like they were trying to hide it. The CEO, Ziv Shoshani, came right out and made it crystal clear. He said, and I'm quoting here, orders related to our growth initiatives, including components for humanoid robots, reached $37.8 million, exceeding our $30 million target for 2025. You see, this wasn't some accident or a footnote. It was a deliberate signal to the market. Hey, our big bet is working, and it's picking up speed.
Okay, so you might be thinking, why does one number matter so much? Well, here's why. It proves that VPG has a real foot in the door of the absolutely massive humanoid robotics market. We're talking about a market that could be worth somewhere between $8 and $15 billion by 2030. If VPG can capture even a tiny sliver of that pie, it would completely transform the entire company.
But here's the thing. This creates a whole new problem. The cat is out of the bag. The secret is out. The market gets the story now, and the stock price reflects that. It's doubled. So the question for us, as investors, totally changes. It's no longer, is this story for real? Now, it's, okay, it's real, but is the stock just too expensive now?
And if you look at the numbers, you can see VPG is definitely not a cheap, old-school industrial stock anymore. Its valuation multiples, things like its forward price to earnings and price to book, are way higher than similar companies. The market has basically slapped a new label on it. It's now a high-growth company, and that comes with a pretty rich price tag.
And this brings us to a kind of uncomfortable truth, especially if you're thinking about buying in right now.
At its current price, VPG is what we call priced for perfection. That means there is basically zero room for error. Any little stumble, any tiny mistake in execution could have a really big negative impact on the stock.
So what's the bull case? What has to go right from here? Well, for the stock to keep climbing, to get into that, say, $70 to $90 range, a couple of big things have to happen. You need to see that rapid growth in humanoid robot orders keep going, and I mean keep going. And the company's profit margins need to make a strong comeback. It's a lot to ask for. It's a tall order for sure.
Now, on the flip side, the bear case is pretty simple. If that explosive growth in the robotics business starts to slow down, or if those profit margins just don't bounce back like everyone hopes, well, then that super high valuation just isn't justified anymore. And in that situation, you could easily see the stock price fall all the way back down towards 35 bucks. That's a huge potential downside.
So, with all that said, what does this mean for you? How should you think about this? The answer, honestly, really depends on what kind of investor you are. This is definitely not a one-size-fits-all kind of deal.
Let's break it down. If you're a long-term growth investor, you might look at this and say, okay, it's a conditional yes, as long as you can handle the potential roller coaster ride. But if you're a value investor, always hunting for a bargain, this is a hard pass. No way. For a short-term tactical trader, it's pretty risky. And if you're just generally worried about the whole economy, you're probably just going to want to stay away from this one altogether.
Look, if you remember just one thing from all of this, let it be this. VPG has officially become a show-me story, not a trust-me story anymore. The idea is fantastic, the narrative is super compelling, but from now on, the company has to deliver the goods. They have to consistently hit their numbers to justify this new, much higher price tag.
And that leaves us with one final big question to think about. Now that the secret is out, now that the stock has already made its huge move, has the risk fundamentally shifted? Is the biggest danger here no longer about whether the whole humanoid robot story is real, but simply about the incredible